Strong US inflation figures have pushed back expectations for a fully priced rate cut by the Fed from July to November. US Treasury yields are up 20 basis points, stocks are down, and the Aussie and Kiwi dollars have fallen more than 1% this morning. That's coming up in our 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, says March manufacturing data for Asia shows India leading the way.
The word exceptionalism in econ speak is generally associated with the US. We are seeing that within Asia, or even in the broader EM universe, India is absolutely can be characterized as India's exceptionalism today.
But first, in 5 and 5 with ANZ, strong US CPI data has caused a major reassessment of expectations for when the Fed will start cutting interest rates, as both headline and core CPI rose 0.4% in March, against consensus expectations for 0.3%. The yields on the US 2-year and 10-year Treasuries jumped 20 and 18 basis points respectively by 4 a.m. Sydney-Melbourne time. The 2-year almost made it to 5% during intraday trading. That caused the US dollar to rise. That meant the Aussie dollar was down 1.7% at 65.14 US cents, and the Kiwi was down 1.3% at 59.81 US cents. The S&P 500 was down 1% and the Dow 1.2% on expectations that interest rates would stay higher for longer. ANZ's head of G3 Economics, Brian Martin, says the data suggests improvement in the CPI measure of inflation has stalled. But the market may have overreacted.
The first fully priced cut now moved from July to November. So a very substantial revision of market expectations. In fact, the market's taken out about 25 basis points of cuts today. Personally, I think it's an overreaction. The FOMC watches much more closely the PCE deflator. The annual measure of PCE core deflator inflation is 2.8%. And for the CPI, it's 3.8%. So I think before you can definitively make a call on when the FOMC will begin to cut rates or by how much, it's absolutely essential to get the deflator data from the PCE.
Number 2, the Reserve Bank of New Zealand kept its official cash rate on hold at 5.5% yesterday, saying monetary policy needed to stay restrictive for a sustained period to get inflation within its 1 to 3% target band this calendar year. ANZ New Zealand Chief Economist Sharon Zollner says her view is cuts won't be on the table until 2025.
The summary record of meetings showed that they discussed both upside and downside risks to inflation, but interestingly, they barely mentioned the higher oil price. We thought that might have warranted a mention. It was just in passing, really. But certainly the upside risks to tradable inflation that we're seeing out there do highlight the fact that headline inflation is still well above where it needs to be.
Number 3, the Bank of Thailand also held its key rate at 2.5%, resisting a call from the country's Prime Minister for a cut. The vote for holding versus a 25 basis point cut remained at 5-2. ANZ economist Crystal Tan says the Bank of Thailand signalled it would take a data-dependent approach for when to cut rates.
Our base case is still for the Bank of Thailand's first cut to come in the third quarter this year. That is when it will have the full set of Q2 data. And that's when it can better gauge how the economy is faring under a more normal fiscal condition, considering that the budget for this fiscal year that started last October only recently got passed.
Number 4, Chinese CPI and PPI data for March is out later today. ANZ Chief Economist for Greater China, Raymond Yeung, expects annual CPI growth to drop to 0.3% as the Lunar New Year effect diminishes. And the PPI is expected to be down 3% from a year ago due to an industrial price war.
In the case of China, we have to wait until the underlying demand to come back domestically so that the demand side will pull up the prices level. And by then, the deflationary pressure of China will be gone. But this process takes a long time because this economic downturn to us is structural.
Number 5, Taiwan's exports rose 19% in March from a year ago That was much higher than the consensus expectation for 7.5%. ANZ economist Sanjay Mathur says that's off the back of strong electronics demand, particularly for AI-related infrastructure, from the US and ASEAN economies.
The earthquake in Taiwan earlier in April might have disrupted production and export pipeline for a couple of days before things normalized. That aside, we remain positive on export outlook for electronics-heavy economies, especially South Korea and Taiwan.
Sanjay Mathur there, who talked yesterday about South Korea's election. And exit polls yesterday indicate the main opposition party looks set for a majority. That's a blow for the sitting president. Now, in today's bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, has reviewed March PMI data for Asia's main economies outside China and says India's exceptionalism showed through.
We had laid out a few macro themes for the year for Asia, which are as follows. First of all, we will see an export-led recovery. Within that, countries with a higher exposure to the tech cycle or to advanced semiconductors would outperform. The second was domestic demand would lag. 3, the only exception to that would be India, which is firing on all cylinders, and that outperformance would continue through the year. And lastly, inflation in Asia is not going to be an issue at all. If there is something that's restricting monetary easing, it is the US Fed and not inflation within the region. And the March PMIs seem to validate our view at this point in time. So we are seeing export orders improve. We are seeing domestic demand lag behind. That's the new orders, which is a composite of export orders and domestic orders. That is trailing new export orders. India is certainly outperforming at this point in time. The word exceptionalism in econ speak is generally associated with the US. We are seeing that within Asia or even in the broader EM universe, India is absolutely can be characterized as India's exceptionalism today. And lastly, Korea and Taiwan, which have a great exposure to advanced semiconductors, clearly they seem to be benefiting in terms of export orders much more than others.
And just digging into those export orders, we did see some weakness in Taiwan's numbers. It looks like the cycle has turned, at least.
Yes. So from the trough of the cycle, there has been a significant improvement in Taiwan's new export orders. The second is that when we compare it with the PMI that is produced by the local authorities as the National Development Council, the latter is significantly stronger, and we would expect that there will be some alignment going forward. Clearly, what we are seeing at a corporate level, when we look at how tech companies are performing, how exports are performing, and this PMI, which is produced locally, the S&P PMI may be underestimating the extent of the recovery at this point in time.
And with those export orders linked to the US economy, do you see that relationship continuing, particularly as the US enters election season?
Yes, I think that is the one area we have to be a little more cautious, because what we are seeing is that the bulk of the demand, or how export shares are changing, is that the share of the US is increasing, and that is likely to continue. And that, on the negative side, is telling you that there is some sort of increase in dependence on the US, and we are moving towards a more narrower path.
I mean, turning to domestic demand, is it lagging?
We think so for the rest of the year. That's partly because domestic demand had surged after the pandemic. It's normalized now. Second, we've also seen fairly aggressive monetary tightening across the region, and that's finding its way through domestic demand.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, April the 11th. Catch you tomorrow with reaction to the ECB's rate decision tonight. Expectations there are for the rates to stay on hold in April ahead of a June cut. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.